Thank you for joining us today for this exciting webinar on real estate. I am Paola Yuspa Abbott, President of Top of Mind PR, a public relations agency. Today we have a panel of top-notch experts to help us put into perspective what's going on in the real estate market and discuss some of the trends for 2021. The global pandemic, a new administration, and new congressional leadership will play a role in the direction of the economy. But these panelists, I promise, will do their best to forecast the direction of the real estate market, at least for the first half of 2021. This webinar is being recorded and will be distributed as soon as it is available on Top of Mind YouTube channel. So with us today is Noah Breakstone, who is the CEO of BTI Partners, Ryan Kratz, who is president of Colliers International for the Southeast region, Howard Majev, who is a seasoned real estate attorney with Saul, Ewing, Arnstein, and Lehr, and Scott Sherman, who is the co-founder and managing principal of Tricera Capital. So I will let the panelists give us a short description of their company, what they do, their expertise. But in the meantime, for those joining us, feel free to submit questions using the Q&A feature on the bottom of the screen. Once we're done with the conversation here, we're going to get to your questions and answer them. So let's start with the introductions. So Noah's going to go first, then Ryan, Howard, and Scott. Noah?
Very good. Thank you, Paola, and pleasure to be here with Scott and Howard and Ryan. And BTI Partners has been developing and investing in real estate for the past 35 years. For the last 10, we have two primary focuses. We've been master plan developers of land for plan unit developments all over the state of Florida. And our second area of development and investment is for mixed use development. We have 3 offices. I'm located in our corporate office in Fort Lauderdale, and we have an office in Tampa and Orlando.
Great, thanks.
Super, and I'm Ryan Kratz. I run the Southeast region, which is about 15 offices for Colliers. I live here in Miami. Our South Florida business is about 75 brokers handling leasing and sales and mortgage banking for commercial real estate as a third-party service provider, property management, project management, valuation and appraisal, and then a third-party engineering services business.
Thank you. Howard?
Hey, my name is Howard Majev. I am a real estate partner. Been doing this for nearly 40 years now. I'm based in actually the sunroom in our home right now. But in more normal times, I work out of our Baltimore office. Saul Ewing is a national firm that has 12 offices scattered up and down the East Coast in major cities and in the Midwest. And we have about 100 full-time real estate practitioners. Our practice out of the Mid-Atlantic offices is focused on structuring, financing, and development activities for our clients. We really are active in all of the major sectors, and we have a lot of skills and experience from ground up work that we can do for our clients.
Excellent. Thanks. Scott?
Hi, I'm Scott Sherman. I'm the co-founder of Tricera Capital. We're also based down here in Miami. We're a owner-operator, mostly focused on urban retail, office, and mixed-use assets, predominantly in Florida to date. And our geographic focus is really Southeast U.S., but we've been primarily keeping our hands busy here in Florida for the last 5 years. Really, focus on that kind of urban retail street activation as well as office, and have also been co-developing with some other partners mixed-use projects that include residential as well. So we're touching a little of everything right now, and excited to be a part of the panel. Thank you.
Great, thanks everybody. So let me start by asking a question that goes to the heart of the housing industry. And feel free, whoever can tackle this, feel free to go first. So what are the challenges that the home building industry, home builders are facing, and where is this headed to the 2021? Where is the housing industry and those challenges heading to, at least in the first half of the year, the new year?
Bill, I'll jump into that in the home building area. What's interesting about the home building area throughout the country, what a lot of people don't realize is actually the supply of developed lots, the supply of land, developed land, is undersupplied, and the demand is greater than that supply. And what's incredible is ever since the great financial crisis, housing starts at that time were 2.2 million. And it dropped all the way down to just under 500,000, about 75 to 80% drop. And over the last 10 or 12 years, the supply of land, developed land, never fully recovered. And, it's an interesting study. It's been done by many economists where they even look today that that the housing supply is about 3 million units undersupplied. And I bring that up because what's interesting is we are land suppliers and developers for the publics and private home builders, and we can't seem to get enough of it to be able to supply them. So I think that's going to be a big challenge as we go, especially with housing affordability and a number of other areas not having enough land to meet the demand.
And we understand that a lot of developers are coming to Florida to identify new like pockets where there is a demand for development, be retail, mixed use, planned communities. So to the entire panel, in addition to Orlando, we keep hearing that Orlando is super hot. What are the next inline markets in Florida and across the US? Howard, if you could also help us figure that out.
Well, I think that, if you look at it from a national perspective, the home building industry, I think, is facing challenges right now. I think absolutely, first and foremost, there's a shortage of supply and buildable land. But there's, because of the virus in part, costs have been increasing. I think a lot of capital that once was available was on the sideline. But there's a tremendous opportunity here, and this is clearly going to be an area of growth as we emerge from the virus and in the near term, because interest rates are going to continue to stay low. Some people at least are willing to live further out than in cities or in the initial ring around cities. People are willing to live further out because they're looking for larger space and working remotely. I think there's going to be a tremendous amount of single family home development, both for ownership and for rental. We're seeing a lot of institutions jump into the single family residential market and become buyers even in scattered site opportunities. And I think there are a lot of traditional builders that are entering the single family market and even catering to millennials with these kind of super duper smart, small projects. Whether it's the Horton Express opportunity or Pulte Centex developments or Seasons from MDC. There are a lot of long-time home builders that are beginning to take a fresh look at the market. And I think that's going to augur well for a lot of work in the industry in the next few years.
Ryan, can you talk about some of the hot spots throughout, the region that you are looking at, or you're seeing more activity, or in your case, Scott, that you're looking at acquiring?
Yeah, so there's two counties I'd draw attention to in Florida, one in South Florida, one in Central Florida, that we're just seeing a significant uptick of activity in. One is Martin County, really the region between Jupiter up to Vero Beach and at points in between. And there's a few reasons for this. One is around cost. So the cost of real estate, whether it's residential or commercial, is certainly lower than Palm Beach County, Broward County, Miami-Dade County. The second reason is around availability of land, and particularly for industrial and logistics, as well as some of the other uses. We're pretty well out of developable land in the three southernmost counties in Southeast Florida. So we're seeing a dramatic uptick of interested land buyers, whether they bank it for a while or whether they act on it, particularly in the industrial space. Martin County seems to be, if you look towards the next 5 to 10 years, going to be quite active. The second one I would say, and this is a little more mature, but not by much, would be Polk County. So right in the I-4, smack dab in the I-4 corridor between Orlando and Tampa. Obviously, it's been a distribution and logistics hub for Florida, not only Central Florida, just because of the central nature of it, but to give you some stats. So just 5 years ago, a large transaction for a lease in Polk County will be a 300,000 square foot, 350,000 square foot transaction. There are numerous tenants in the market that have not only inked deals, but are in the market either both publicly and quietly, that are 400 to a million, 400,000 to a million square feet. And it's the access to the interstate I-4 corridor, it's access to Tampa Bay and Orlando region, and just the ability to distribute throughout Florida that is attracting large users there. And what follows on that, of course, is going to be retail, housing, which is a lesser expensive option than both urban Orlando or urban Tampa Bay, and everything that goes with it. So I think you'll see both counties develop probably faster than the average if you look forward 5 to 10 years for Florida.
Thank you, Scott. What do you think?
Yeah, so I'm a little more focused and bullish on I guess more of the obvious, which is Palm Beach down to Miami. I think just really because we tend to follow the residential growth and density. So on the retail and office side, I just think that with the growing population density and the migration that's only been accelerated throughout COVID, the Southeast, part of Florida is going to benefit significantly in demand, and for those other food groups is going to increase. And we're seeing the same thing on the west coast of Florida, from call it Tampa down to Sarasota, where we're also very active and very bullish on the growth over there, both on the residential and employment front. So I'd say within Florida, those are the two sides of the state that I really like.
Yeah.
What about you?
Yeah, I would just add, it's interesting, Ryan, that you mentioned Lakeland or Polk. Actually, Lakeland showed the greatest increase in permits year over year. And, I'm a big believer in Tampa and Orlando too. Listen, fundamentally, Ryan said there is no more land, Dade, Broward, Palm Beach County. You have Everglades on one side, the ocean on another, and a very constrained landmass. But if you start looking at Jacksonville, Orlando, Tampa, the St. Pete market, and then go down the coast to Sarasota, I mean, what you're going to find is more affordable land, affordability for the cost of living, a very nice quality of life. And you're seeing a lot of companies move into these areas with job growth opportunities. And we're seeing the population growth there. So I think all the major MSAs that we're seeing in Florida, we're very bullish on, and I think we're going to see a tremendous amount of growth.
Awesome. Now let's move to retail, because that's on everybody's mind. With retail taking a huge hit as a result of the pandemic, what trends are you seeing in that industry, that sector, and when do you expect that industry to recover? Scott, I know you do a lot of retail.
Yeah, I'm happy to take that one. I find it, interesting with the headlines in retail and how everyone kind of thinks that all retail's really in trouble and struggling and dying for the most part. And I just think there's two very different worlds of retail right now. And that's what I think people need to start understanding. If you're looking at suburban big box strip centers and malls, a lot of that stuff is struggling and probably does need to be repurposed in some position as some of these properties lose major tenants, and I think it's gonna be hard to re-tenant with traditional big box type uses. Although other uses are coming into those types of retail properties these days, whether it's more logistics and industrial or things like that. However, the more of the urban retail, which is more of the retail that Tricera focuses on and acquires in these kind of dense urban markets and neighborhoods, has actually weathered the storm relatively well. I'd be lying if I said that our tenants didn't feel it during the last nine months of 2020, but our portfolio on its whole, which is predominantly retail in these markets, has fared very well. We didn't have one property where we had an issue with a lender going to special servicing or anything like that. We lost, I think, throughout the whole pandemic, less than a handful of tenants across our portfolio. And so What that told me is two things. One, the markets and the types of retail that we've been focused on, which is that urban environment retail. There's still a need for it. If you've got thousands of units of density and bodies around, people still want to go find a place to eat or for the convenience and neighborhood type uses. And also, a lot of those retailers were able to adapt and utilize some of these delivery apps as well to kind of pick up the sales where they fell off from in-person type experiences. So look, retail is definitely evolving by the day. The internet's definitely changed the landscape. But what's funny now is we're actually seeing a lot of those category killers, the internet-based companies that everyone was scared of was going to kill retail. They're the ones now looking for retail storefronts. So it's evolving by the day, and we're seeing new concepts, whether it's the ghost kitchens or something else coming into these urban environments. The demand's still there. I think there's obviously a lull in the market, but I'm still bullish for the right types of retail. And so in markets like I've mentioned before, I think retail's going to be just fine.
Yeah, I couldn't agree more. I think the exciting part of retail and the retail sector is how it will change over the next several years and the next 5 to 10 years. I think you're seeing a lot, if you look carefully, you're seeing a lot of change in the industry and in the product. Some stores that were bigger are becoming smaller because they're losing the warehouse space that they once needed internally to show. That creates opportunities. We're working with a developer on the East Coast that is taking an old center, keeping the retail that is good still operating there, and is actually putting micro residential units in the center. And is also taking an old Sears store and making it into a fulfillment center for one of the big e-commerce giants. So you're seeing what the real estate industry does best in terms of creativity and making the new solutions work and overcome the old problems. The other thing we're seeing is landlords buying some of their retail tenants. Obviously, that keeps up occupancy. You wonder whether that also inflates rents, but Brooks Brothers and Aeropostale and Forever 21 were bought by Simon, and there are other big landlords who are buying tenants who need some propping up. So I think that's interesting to watch. I think anchors are going to change in our centers, and there's just a lot of, to me, retail presents perhaps as much or more opportunity than any of the other sectors. But clearly, there's been a lot of hurt over the last year because of COVID. But it's going to be interesting to see how we come out of the problems.
No, I don't know. I don't know if you want to.
I'm interested in Ryan. I know, Ryan, you're involved with your advisory. What are you saying there?
Yeah, so I think first, if you just look at the data, just take Miami-Dade County, for example, vacancy still only 5% or even sub 5% on retail. Now, there may be some more give back space as it still sort of unwinds, but we think it's leveling out. And really what it is a tale of two cities. So Class A retail, well-located retail, or shopping centers that have necessity retail or grocers in it have done pretty well. And if I go across our 60 some, leased assets that we handle for our ownership clients, they're doing pretty well relative to, in some cases, we have tenants that have been waiting around for certain spaces to become available, like end caps or outdoor dining, the things like that are very attractive in South Florida. And literally there's, tenants that are asking us, calling weekly, is this available? Can I step into this? Do you have a weak tenant for this? So that's the side of retail that's very healthy. Certainly some of the Class B centers, or maybe even lower than that, or poorly located, where they've had non-credit or low credit tenants, they have been more challenged because those are the ones that are very impacted, the true mom and pop, which is a bit of a challenge because we need those in our economy to have a broad-based, strong economy. Those are the ones that are feeling more of the pain. Some of that's been lessened by the PPP program. We'll see if there's a second round of that and to whom it gets directed here shortly. Some of the predictions that I'd have sort of for this year is I think you'll see a pickup on Miami Beach of retail. My advisors are already saying, the brokers are already saying, we're already seeing a pickup for 2021. That's been pretty quiet over the last few years. So that's promising. And I think we think that mostly the rental rates have stabilized at this point. There may be a few additional concessions that were given, but for the most part, retail landlords that are not under distress, as was mentioned earlier, are completing deals at what you call meet the market rents these days. I think the other thing that you'll see transform, there's two more comments in this, is you can't talk about retail in South Florida without also talking about medical. And healthcare services have found retail locations to be, in many cases, very good real estate for them to locate their businesses in. Number one, they often have great parking, easy access, well located, all the things that healthcare providers need to have for their patients, their customers. So you'll see more and more of that take up certain retail locations, which will be helpful to the market. And then lastly, relative to e-commerce, I mean, we generally at Colliers, our research people generally think we've topped out at the amount of net new e-commerce activity that's out there. Meaning during 2021, we as a society went out and bought a whole lot of things online, but you're not seeing a lot of net new online buying at this point, meaning we may have maxed out what people want to buy online, and the rest of it, they want to go to stores. They want the shopping experience, the experiential component that has always been retail. So I think what you'll see is there's a term called omni-channel retailing, which if you think about restoration hardware, they do it probably the best. The catalog looks the same as the website, it looks the same as the store, and the experience is the same through and through. The retailers that do that really well for their customers, where you can buy it how you want and pick it up or get delivery at your election, and that experience is similar, not disjointed, those will do really well. And that's, if you go across the board on retailing, that's what they're all after right now.
And Ryan, just to pick up on what you said, by the way, Restoration Hardware has done such a great job. I was there to their store in Palm Beach, where they have a restaurant on top of their store. And yeah. I mean, they're so innovative and imaginative of how they create the market. So retail has not been our predominant business, but it's been a sideline that we're developing more and more. So as we've done, we have a development in Tampa called West Shore Marina District, and we have 3 condo towers there. And we have a limited amount of retail, about 30,000, 35,000 square feet. And what we're finding that's working for us is really the specialty retail stores, the restaurants, the wine bars, the coffee shops, the hair salons, or foot massage salons that really service the immediate retail in that area. And we're getting a tremendous amount of interest and a lot of success in that area, where it's really limited and controlled and very specific to that neighborhood. And we're finding great success with that.
So overall, good news about the retail sector. So moving on to our next closed acquisitions and dispositions, in at least in the first half of 2016.
2020.
Yeah, so the darlings of the industry right now, and certainly last year, have been industrial and multifamily. There's a lot more multifamily out there, and it's a lot easier to place bigger dollars into multifamily. So inevitably, that's the one that had risen to the top last year. It doesn't hurt that Freddie Mac and Fannie Mae were very aggressive in lending to that space, whereas life insurance companies, banks, and CMBS pulled back last year just to make sure that their underwriting has been correct and is correct going forward, whereas the agency lenders for multifamily have just powered through this. I think in the short term, not a lot changes. There is incredible demand for industrial properties. The problem is, at least in Florida, particularly South Florida, not a lot of that trades. And if you really want to put out a lot of money, it's really hard. It's really hard to put out $100 million for industrial. Once you get down under 20 or 10, there's a few more options, but it just doesn't trade with significance. And when it does, we usually hit record high pricing. And provided that interest rates stay low this year, I suspect you'll see some new records set as well, just because of the sheer amount of capital that would love to make its way into industrial real estate. And there is a belief that logistics, transportation, cold storage, all of the e-commerce activity out there will lead to a long-term run for industrial, at least a half a decade run for this. So I think you'll see more of the same there. We need price discovery in office asset trading. That's what we haven't seen a lot of in 2020. So underwriting for which tenants stay, which tenants might depart, which tenants might downsize. What's the uptake for new leasing in net new leasing in office, and what period does that go over? We need to see a few buildings trade before there is sort of mass consensus on what the cap rates are and the valuations are for office buildings. And then retail is just so specific. I mean, a Class B enclosed mall is just going to trade so differently than a Publix anchored center, which still has a lot of demand, even though you hear a lot of negative things about retail. Necessity retail, single tenant retail, grocery anchored retail, all very attractive. It's just when you get to some of these larger box retail shopping centers that the underwriting gets tricky. And I don't look for a ton of those to even come to the market, because I think the ownership groups know that it's just a tough sell right now until some things shake out.
Yeah, I agree with a lot of what you said. In terms of the industrial, it's clearly a very hot area. It's interesting. We're seeing and working with a couple of people who are trying vertical industrial. So literally 5-story industrial buildings in New York City. I think there's going to be a lot of change in the marketplace. I think there's going to be some tear down of older industrial buildings to give way to sites for new AI infused and smart new industrial buildings. I think it's going to be interesting to see how that develops. On the housing front, there's a huge boom and need for affordable multifamily housing up and down the East Coast and on the West Coast and other parts of the country. I think the Biden administration is obviously going to help light the fire for more of that development to fill that need. But at the same time, as we talked earlier, there's a huge single family residential need. I think there's going to be new buyers and owners entering the market, institutional types who will fuel in single family growth. And the other area I would think about is life sciences, but not only the shopping centers that are becoming little medical parks, which is wonderful. I go to one of them, but actually going away a little bit from the traditional life sciences centers on the West Coast and in Boston. I think there's going to be a fresh look at bigger cities like Philly and Dallas and Miami, places that have great hospitals and a talented pool. And I think life sciences will have growth in those areas as well.
Like Ryan and Howard both said, there's definitely a lot of capital flowing towards multifamily industrial life sciences right now. So I'm definitely going a little bit against the grain. We've been focusing predominantly on retail and office. In fact, Q4 2020, we really started focusing pretty aggressively on buying office in Florida specifically. And I just see the opportunity now when the capital's kind of scared and not pulling the trigger. As Ryan mentioned, looking for price discovery. We're currently in contract on an office building in Miami right now, and we're closing on an office building next week in Sarasota. And these are assets that we're acquiring because we just see the population growth and continued density coming to these markets. And I'm a believer that once COVID will pass, and when it does, people are going to return to the office, whether it's the same exact capacity, TBD. But I also think that in these markets we're focused on, the additional growth of new companies coming into these markets is going to more than make up for any loss of office space from the existing tenancy. And I think a lot of people are overlooking it right now. And so we've been very actively focused on this little window in time where I think there's an opportunity to be opportunistic and buy office assets. We're still staying focused on retail as well, and we're in contract on a retail deal right now as well. But I'll tell you this: getting financing and capitalizing these assets has been extremely difficult, and it's because most of the capital, most institutional world is still very concerned. They don't know how to underwrite it, and a lot of times it's just that herd mentality. So fortunately, we are able to kind of figure out how to capitalize these deals and get them closed, but it's definitely been a lot more challenging than it has been in the past.
I think our direction, Paola, in this area, similar to what everybody said here, is we're looking, every market it has its own sensitivities and differences, whether it's Tampa, Orlando, and South Florida. But something that we're working on in South Florida is South Florida is growing, land is constrained, and it's about emerging and reimagined neighborhoods and infill development, no different from what Midtown, if we looked at it 10, 15 years ago, Wynwood, And so we're putting our money on Hollywood and in the Hollywood Circle area, Young Circle. A great example is we bought a strip shopping center that used to have the Publix on it, a Hollywood Young Circle, just east of 95. It's about 1.25 miles from the ocean on Hollywood Circle. And we bought that from Regency. And right now we're in the plans of going to tear that down in about 12 months and look to do 2 mixed-use towers in that area. We love the fact that where can you find a 10-acre park right in the middle of this circle, close proximity to the ocean, easy access to Fort Lauderdale, easy access to Miami. So we're really looking at these neighborhoods and how to reposition older product and make it new in this vibrant market. Also, we have under contract, we're closing shortly for the Hollywood Bread Building. We're going to come out with another mixed-use project right next door, 360 units of multifamily in a tower and ground floor retail. So, our goal is to, take some of the distress that we see in retail or these different neighborhoods and really recreate what we think are new and exciting, vibrant products for the neighborhood. And so no different from what we did in Tampa with the West Shore Marina District, where that was an industrial site, that we made it all a resi site with a retail and single family and condo towers. So our goal over the next couple of years is to rediscover new neighborhoods in areas that can't be replaced.
Thank you very much. I wanted to ask you about, we keep hearing, and we actually are seeing that a lot of people from the Northeast and people from the Midwest are moving to Florida. How is that shifting or transforming, cities, communities? Are you as developers and as brokers benefiting from this influx?
I'll jump in because I have a couple of active products. I think that's going to be we're seeing it as a pretty remarkable change. Like I mentioned, we have 3 condo towers in Tampa. In the last 3 or 4 months, I would say 70% of our purchasers have come from New York or the Midwest. And that great indicator called the U-Haul, what is it? The U-Haul, Ryan, tell me.
It's the measurement of who's moving where and from where.
There you go. The net effect is it's an inflow to Florida. And I think COVID's accelerated it. I think New York and the Midwest, a lot of people are saying, well, maybe this is temporary, but I think we're seeing more and more activity in these major markets. We see it in South Florida with a lot of private equity firms. We're seeing it in Tampa. JP Morgan just announced a huge shift about 1.5 years ago of a tremendous number of their back office facilities. I think that's going to continue. We're excited about that growth as it goes in the various markets that we're in.
Excellent.
I couldn't agree more with Noah on that. I mean, it's incredible what's happening. I spent over a decade of my career in New York, and I probably get a call a day from someone from New York who's moving to Florida, asking where they should live, where they should buy a house, where they should move their office. That was happening pre-COVID, but I think since COVID, it's only accelerated to another level. And now what we're seeing is not only that kind of New York Northeast migration that was already kind of happening, but now we're seeing it from the West Coast too, with Silicon Valley. And we've been hearing a lot about tech companies now looking to relocate to Florida. So I mean, we're drinking from both ends of the hose right now, and I hope it continues.
Let's hope that continues.
And Howard, we have plenty of room for you in South Florida too.
Well, it's interesting. One of the questions I was asked on a panel a couple of weeks ago was whether the virus was essentially going to be something that killed cities. And that's a really interesting question. But having thought about it a lot and looked at the issue, I think the millennials are going to want to stay in cities, maybe not the same city, but there's something about cities and the wonderful environment they provide in terms of living and working and playing in the same area that is going to be, I think, that factor which is going to keep cities strong. And I think as we get out of this, cities will look a little different. The retail will look a little different. Maybe the merchants will look a little different. But I don't think the pandemic is going to be the end of cities. In fact, all of this is cyclical to some extent. And my grandchildren may not want to live where I lived or where their parents lived. But I think the cities are secure. They have lots of issues, but particularly in terms of housing. But I don't think the pandemic is the end of cities.
Awesome. So let me ask you one more question before we let the attendees ask their questions. So our lenders, let's talk about financing, deals, acquisition, refinancing, construction. Are lenders growing cautious, or are we still seeing the same appetite for financing, refinancing, providing construction financing when it comes to traditional lenders and maybe non-traditional lenders?
I'll jump in to start. Listen, my feeling is this. I know many bankers. I haven't seen the money center banks or regional banks or local banks really actively back in the lending business since the Great Recession, since the market crashed. And you see that predominantly when you see private equity firms in the lending business. And I think the money centering banks are there. It's very tight. And it's in the sectors, like we talked about, whether you're industrial logistics, multifamily, residential for sale or for rent, mixed use. I think you're going to see plenty of appetite. And when you get to hospitality, retail, office, commercial, it's extremely tight. It's just a mixed bag. We just closed on a loan for a condo. And Tampa is very similar to what it is in South Florida. You have to have significant pre-sales. You have to have significant deposits. If it has a mixed use component, you have to have a significant amount of pre-leasing. You're going to get a loan. You'll be able to make it work. And, the loan to costs are much lower than they ever been, and they're very tight. But money's there. It's just on the traditional banking side, it's clearly tight. And in the non-traditional side, you have to pay a premium.
Yeah, the financing world, I would just echo that, is challenging right now. We were closing one retail deal in the middle of the pandemic, and we actually had a lender signed up call it last January. Closing was happening in April. Come March, lender pulls out, and we were scrambling to find a new lender. We ended up having to pay much higher rates from a private group just to even get a finance. Obviously, this was in the heart of lockdown when everyone thought the world was ending. So that was probably the worst or most extreme example. But I mean, it was really challenging to get that deal financed to close. Fortunately, we were able to get it done. But even today, it's definitely been tougher. We just broke ground on a mixed-use development in Wynwood that we're in a joint venture with Related. And again, we were able to get a finance, but we had a term sheet at 65% loan to cost pre-COVID. And obviously, by the time we kind of moved it forward to groundbreaking, that LTC went from 65 to 55%. So still lent, but obviously at a much lower leverage level. And then on the office buildings we're buying right now, same thing. We were able to get some decent financing terms, but lower leverage. And it wasn't like we had 10 lenders lining up behind each. We probably had 2 or 3 decent options, but we didn't have 10.
Yeah, I agree. There's clearly a lot of money sitting on the sideline that isn't being deployed right now. Metrics are tougher from commercial lenders. Rates are higher. And I think in the long run, that money will be deployed because that's why it was raised. That's why that's its purpose. In the short run, I think all of us in the industry are going to have to do what really what we do best, which is be more creative. You may have more players in your capital stack. You may have to think differently about your capital stack. For those of us who do a lot of affordable housing, the state and local governments may not be as available to lend money and provide secondary mortgages. So you're going to have to think about going back and saying, can I have more density on my site, and figure out other ways to make the capital stack that you have work. So it's what we in the industry do best, and I think creativity will be the guiding light in the short term, but I think ultimately the money will be back.
It seems that the adage, if you don't need a loan, you can get a loan, is more true than ever right now. So it is.
I didn't realize anybody else knew W.C. Fields as I do.
Yeah. To draw a parallel to this, because I agree with the other comments, is you would think, and I would have thought, and it's been a surprise through 2020, that the lenders on some severely distressed assets, so think about hotels that are primarily convention center hotels that require travel and conventions and lots of people getting together, not the beach hotels, which have done reasonably well, not some of the limited and select service hotels. The government has allowed the lenders to largely set aside any of these troubled properties and not count against the bank ratios that they need for health. And therefore that has sort of extended anything that might happen to properties that are in trouble. So you'd think that a year in now, we'd be seeing in the marketplace distressed assets starting to hit the sale blocks, whether it's through the auction or through brokerage houses like ours. And we've done some BOVs which is usually the precursor to sales for some of our lender clients, but it's been stunning how quiet it is. It's not like what we went through in the global financial crisis, where within 6-9 months after it had started, the lenders were starting to push out property that they didn't want to hold or couldn't hold. So we think that largely we will kick the can down the road as a country and as a lender group. There may be some just severely distressed assets like some of those big hotels that I mentioned earlier, or truly broken retail that will be opportunistic for, I know a good number of the participants on this call may be opportunistic investors. There may be some dislocation of pricing in those regards, but I wouldn't expect to see office buildings, certainly no industrial, probably not Class A retail, probably not multifamily unless there's a big change relative to evictions and the process that goes around collecting rents, to just hit the market even in the coming year. So it's been very interesting to watch the non-activity around the distressed market when a lot of capital was sitting on the sideline ready to pounce.
Understood. So we have a question from an attendee. If capital is difficult to come by for the big entities, how are the smaller tenants able to capitalize for build outs? Won't that create a huge divide between the smaller businesses and the well-funded landlords? Are landlords having to help bridge this gap, this divide? I think, Scott, maybe you can answer that.
Sure. Yeah. So it's a great question. Look, I think right now it is still a little bit more of a tenant's market. And so tenants are, if you want to lease your space, landlords are going to have to recognize they're going to probably need to give some decent TI packages to get the right tenants in. But with that, the challenge to that, and kind of going to what the question was about with the smaller tenants, the small, less, not the big nationals, is landlords are a little less willing to give big TI packages to tenants that don't have very strong financial backing, because you're taking a lot of risk building out a space. So there's still that give and take. It's a tough balancing act. I like to say we're more betting on the operator than we are on just the credit of a tenant, because credit has changed. If you look at the last 10 years, tenancy power credit are now gone, and vice versa. So it's a tough question to answer, because it's really going to be case by case. But I will say this, and I think this is just something that I think is people appreciate. I think over the next year to two, you're going to see a ton of new kind of restaurateurs, chefs that have always wanted to go off on their own and start their own restaurant. You're going to see a huge wave of kind of new kind of foodie restaurants popping up in these cities. And the reason is you're going to see a lot of, there's a huge inventory of secondhand restaurants that have died through the pandemic. And so these are built out restaurant spaces that cost hundreds of thousands of dollars to build out. So a lot of chefs who maybe didn't have the capacity, the capital to invest in and build out the infrastructure for a restaurant now can step into an already built out second generation restaurant and not need a ton of capital from the landlord or really from themselves to get open. And so I think you're going to see a lot of new chefs, first time restaurateurs coming out of this. That could be, really exciting to see and try out.
I just on that, Scott. Yeah, I think the concept I really love, and you probably have seen it. It's around in South Florida too, but a great example is in Tampa, on the river at the waterworks, and where they're doing really these older structures or new structures that are food halls, and it's a great way to have emerging chefs be able to have more limited space and to do a food court, a luxury food court. I think that has a tremendous amount of appeal, and I think we're going to see more reincarnations of that concept.
Yeah, so to actually add to that, no, so there was another food hall right next to Armature Works. I don't know if you ever went there. It was called the Hall on Franklin. I don't know if you're
Yes,
familiar with it.
yes, I
So
am.
we're actually partners. We're investors in the Hall on Franklin, and we've been trying to roll them out pre-COVID. And throughout the last 6 months, the amount of developers throughout the country that have been courting this operator to come into their space, activate their ground floor, take 10,000 square feet and do a really great activation, and the amount of TI money that's been thrown at him. I mean, we have about 5 or 6 new locations in the pipeline right now. It's been incredible for the growth of this food hall. So you're right on.
Yeah, I love that concept. That's a great. I was there a couple months ago, and great chefs, great concept, and I think it's a terrific model.
Excellent. So another question, how is the recent increase in interest rates reshaping your appetite for borrowing in the next 6 months or so?
There you go. That's your answer right there.
Yeah.
No problem.
Listen, here's the issue with interest rates. They're historically low, though. They're near zero. The only one problem is I can't borrow at that rate. And so the spread with lenders today, it's hard to really take advantage of that spread as a developer. Now, and I bring that up because for the home buyer, it's fantastic. Because that's one of the additional spurs in the increase in home building and home buying is because with interest rates at their historic lows, it provides on a 30-year or 15-year mortgage incredible affordability. So right now in many markets, the trade-off between renting and owning, it's less money to own. So the benefit to have that with Fannie and Freddie with 30-year mortgages that are fixed, I think will be an added asset that will continue to spur on the housing market.
Typically, as interest rates rise, if they rise in a manner that is controlled and transparent, where the Fed is sharing their thinking, that doesn't upend the real estate market too badly. So in fact, as it was said earlier, the industry is like a herd. We kind of sort of move together. And as rates rise and it's predictable and it can be built into financial models, it's not a problem. Now, if rates are erratic, whether they spike or they have to be dropped in order to incentivize the economy, that's when things get difficult on the investor side and the lender side, because there's challenges on underwriting how real estate will perform. Usually if it's a slow rise over time, which is necessary for the economy because you need to be able to have interest rates as a tool to combat recessions. If they rise over time, investors can plan for this. They can estimate their exit cap rates. They can estimate the growth in rental rates. They can essentially inflate their way out of a rise in rental rates. In interest rates. The problem is when they're erratic or they go too fast. So we'll see how it transpires. Most economists are betting that we're in for a 2-year, fairly sort of steady, either stable rates or just a very slow rise.
Great. So David asked, are you seeing any interest from international investors from South America, China? I assume he may be asking about buyers, investors, commercial real estate or residential real estate.
The answer is yes, and the reason is one thing. It's a very short answer. The euro is up compared to the dollar. The Europeans are back in South Florida, particularly Dade County, in a big way right now. I know numerous deals that have been revived with European capital, and it's all because of the exchange rate.
Yeah, and I can add a little to that. You know, Paola, we have a condo hotel in Orlando. It's called the Grove Resort and Water Park, and it's 900 units. It's 2 and 3 bedrooms, and 85% of our buyers are international. And our biggest buyer is their number one theme is safe harbor, having money in the United States. And if they can make money on their investment and have a cash flow, even if it breaks even or makes a little money, they're happy. You know, and so we've seen a tremendous number of buyers from Central and South America. Actually, we've seen a tremendous number of buyers from China. We have a small office in Beijing. We sold a significant number to Chinese buyers. And so I think that will continue. Even though that we saw a little unrest on January 6th, just for one day, you know, I think we're going to continue to see the international buyers.
So we have somebody's asking, Noah and Scott, can you talk about the type of deals you are looking for and where?
Well, I'll go Noah. I mean, yeah, kind of like what I've already said, where it's really Palm Beach, Fort Lauderdale, Miami, and then I'd say Tampa, St. Pete, and Sarasota on the West Coast are really the main markets we've been focused on right now. Markets that we're already in and markets we're currently active in. We just see a lot more velocity there. And instead of trying to geographically stretch and go to new markets, I think there's enough potential opportunity in those markets right now for us to continue focusing in those markets. And then, you know, what we're looking for, it's more the same, the urban mixed use, retail, office. If it's got a residential component, we'll look at it as well. Typically we'll bring in a JV partner if there's a residential component, like we've done with Related in 13th Floor and other projects. But that's the extent of really my focus today. Noah, you want to go?
Yeah, and Scott, we're similar. You know, like I said, we have offices in Tampa and Orlando, and of course, South Florida, and we're going to probably open an office next summer in Jacksonville. So we're looking for 2 primary areas. We have a land division that, again, where it's next in line land. So we're buyers of tracts of land that are on the path of growth, anywhere between 500 acres to 3,000 to 5,000 acres. They tend to be larger in size because it provides a limited competition for us. And we do the master infrastructure, water, sewer, drainage, and paving. And our time horizon for that area is 7 to 10 years. So we're patient capital in that area. And the next area is really infill, similar to what Scott does, mixed use, high rise, mid rise, a number of uses. We're looking at a number of older, dated indoor malls that we're looking throughout Florida in terms of repositioning those properties. You know, I think the bottom line for us is we tend to do larger projects and fewer of them. So having some size and scale, it seems to work better with our organization.
Perfect. And I think we have room for one more question. Somebody's asking, why has the housing market remained so strong during the pandemic, considering that many people lost jobs or had their income slashed? Even with mortgage rates near history lows, if you don't have a steady income, you can't afford them. Who wants to take that question?
Well, it's in my backyard, so I'll jump in. You know, it's a great question. You know, with unemployment right now, probably at 6.5% compared to where it was. You know, the housing market, like I said, the for sale housing market has never really recovered from the Great Recession. So what's happened is there's been a tremendous number of renters now that are looking to, you know, they have a family or they're about to get married and they have kids, they want a yard, the pandemic hit, and they're looking at the trade-off. What do I pay in rent? and look what it costs me to own. And they're finding out in a lot of these markets that ownership is less than renting. And I think that's been a very big indicator of what's happened over time. The millennials, I'm saying the number off the cuff, ULI did it in their trends update, that there's 8 million millennials in their 30s that put off buying a home during our recovery from the recession, that were renters that are now looking for a home. And I think that was the impetus with especially with COVID, when they wanted to get out of the cities, out of a rental, find a yard, find some space for their family, and reopen the suburban appeal. And I think that will be something, I think, where we see markets that have land availability, that will continue.
I think in terms of the rental market, you also had a number of states and cities step in and put together legislation which prevented evictions and kept people in place. So I think that skewed the numbers to the more positive, at least for the short time those were in effect. But the truth is, talking to a lot of our clients, particularly multifamily clients, they were inclined to work with their tenants. And if there was a shortfall for 1 month, 2 months, 3 months, there were workarounds. It was better to have a tenant that you had confidence in once the tenant got another job in place, rather than to start searching. And obviously, people can't hang on forever that way. But I think the industry, just as lenders work with borrowers, I think landlords work with tenants in many instances, many instances, for the greater good and for a mutual economic benefit.
We still have 3 more minutes. Somebody is asking, with agricultural land in Florida disappearing, is there any movement to vertical agriculture buildings? I don't know if anybody can tackle that.
I think it's a great idea. I'm not an expert in that space, so I really couldn't opine. But yeah, I was actually strawberry picking with my kids in Homestead this weekend. I was seeing all the developments happening down there, and so I agree. It definitely seems like it's shrinking by the day.
I'll give a little perspective on that. It's a funny thing that when you look at the vast amount of land that we have in the United States, I think the number that was last reported that was developed out of all of our land mass is about 3.5%. So we have plenty of land. And what I tell people is, I know this city seems so dense, but when you fly to another city, look out your window, there is a tremendous amount of green area. So even though we seem to compress into cities and suburbs, there is plenty of land within the United States.
Great. Well, I want to thank you so much for taking the time to do this webinar, being so generous with your time. Well, thanks everybody for watching. We're very happy you join us, and we hope to see you again soon.
Thank you.
Thank you, everyone.
Thank you.